Hello investors, welcome to Simpli Stocks. Continuing our series on stocks for market correction. In today's second video, we will study a moated large cap monopoly business. Right now, it has fallen quite a lot due to the geopolitical tensions. But from a long-term perspective, this is a very good business model, a very strong business model, so to say. So the company I am talking about is Indigo or InterGlobe Aviation. In today's video, we will understand that even though Indigo is currently facing multiple headwinds like airspace closure, rupee depreciation, and rising crude oil and aviation fuel prices, at the same time, we will also look at why Indigo is still in a very stable position and how it can overcome all these short-term issues and perform well in the long term. So without wasting any time, let's get started. So Indigo's problems started around the end of November and early December when new FDTL norms were supposed to be implemented. These rules were introduced for pilots and cabin crew to ensure that they get the mandatory rest as they often, work over or beyond their schedules. So the idea was to improve safety and reduce fatigue risk. However, Indigo was not fully prepared for this. When norms were about to be enforced, there was a shortage of staff, which led to a large number of flight cancellations and delays. Between 3rd to 5th December, more than 2,500 Indigo flights were cancelled and hundreds were delayed. So, to manage the situation, the government stepped in and reduced Indigo's airport slots by around 10%. And just as the company was recovering from all this, the FDTL issue towards the end of the February, war between US, Israel and Iran began. We will discuss the war impact in detail later, but for now, understand that this slot reduction was temporary in nature. The government had to intervene because Indigo holds around 64% market share in India's domestic aviation. So, such large scale flight cancellations and disruptions obviously had a big impact on the economy and population. But the company will come out of this crisis as Indigo gradually adjusts to the FDTL norms. This issue should not remain as a long term problem. Also, airport slots are allocated by the airport operators. They are not permanently controlled by the government. So there is a good possibility that capacity will normalize or get back to its normal course over time. So we can say Indigo has come a long way ahead of this issue or will do so easily in the near term, and that is not going to haunt the company anymore. And let us say even if some slots are given to competitors like Akasa or Air India, they currently don't have enough aircrafts to fully utilize that also. So we will understand this in depth later in this video, that there is actually a shortage of airplanes in the sector, which is working in Indigo's favor, and it should work in their favor also in the long term also. So in fact, this itself is a big trigger. New aircraft deliveries have a waiting period of around 6 to 7 years, and Indigo alone controls around 60% of pending orders or order backlog of aircrafts from India. So this is a huge trigger, which we will understand in depth in the future, later in this video. Now, a humble request, just before moving forward, if you are liking this video so far, do give me a thumbs up. Also, you can subscribe to our channel Simpli Stocks, where we bring multiple such videos every week. Honestly, your likes and subscribes are our only motivation so that we keep bringing such high quality research to you for free. So do like this video, and yes, also subscribe to our channel. Coming back to our discussion, so as the company moved past FDTL issues, an even bigger problem for Indigo has emerged, which is the Iran, Israel and US war. Because of this, the company is getting hit in two ways. Firstly, revenue or sales have come down, and secondly, costs have increased. So let us understand both of these one by one. The first impact is on revenue or sales side. Around 30%, India's international air traffic comes from UAE alone. And this does not even include other Middle East countries. Plus, what's more, flights going to Europe usually pass through the Middle East. But due to the ongoing war, the airspace there has been closed for civil aviation for safety reasons. What that means is the direct Middle East flights have obviously been cancelled. Plus, the flights to Europe are now being rerouted via Africa. Around 20 to 23% of Indigo's revenue comes through the Gulf region, And right now, that entire portion is getting impacted. That is the first problem. The second problem is that due to the war, crude oil prices have gone up sharply. Earlier, crude was around 60, 65, but now it has moved past 100, 110. Because of this, the price of aviation turbine fuel, which is used in aircrafts, that has also increased. It has gone from around 90, 95 rupees per liter pre-war to about 115 rupees per liter now. So with the rise in ATF prices, Indigo will have to take a hit of around 1600 crore rupees, because apart from aircraft leasing, fuel is the biggest cost component for any airline. Around 30 to 35% of an airline's total cost is fuel only. So any increase directly puts pressure on the profit margins. Now, to manage this, obviously airlines are adding fuel surcharges. If you have booked a flight recently, you might have noticed it as a separate line item. But this only partially offsets the cost increase, not fully. And in India, ATF prices are revised fortnightly by Indian Oil Corporation. So there is always a 2 to 3 week lag in adjustments. But anyways, because of this, the full impact of higher ATF prices will start reflecting from the Q4 results anyways. So these are the two major problems right now: airspace closure and loss of business, and rising ATF prices, both of which are affecting Indigo significantly. But here you need to understand and think from a long-term perspective. At some point, whether in 1, 2, or 3 months, this conflict will eventually settle. So instead of focusing only on the short term, you should look at the long term visibility and sustainability of the business. You have to look at the long term picture, at the big picture, so to say. So Indigo holds around 64% market share in India's civil aviation sector. And think for a moment that such a large, dominant business cannot simply disappear from the market, right? In fact, we will also soon understand why Indigo's dominant position will likely continue in the future as well. Now, moving on, apart from these two issues, there is a third and slightly more, I will say, structural problem, which is the fall in the rupee. The INR has been depreciating against the dollar, and this is an issue that will continue even after the war ends. For Indian airlines, most of the expenses or payments are in dollars. So when the rupee weakens, the company has to pay more in rupee terms for the same amount of dollar expenses. For Indigo, the biggest cost here is its lease obligations. The aircrafts it operates are largely on lease. So as the rupee falls, the company has to pay more money for those same lease payments. Apart from this, there are several other costs as well in aviation, like aircraft and engine maintenance reserve payments, sourcing of spare parts, international ground handling costs, overseas staff expenses, and also the fees which is paid to the international air navigation service providers. All of these are dollar linked expenses. So all these costs will rise, they will increase. If you look at the data, you will see that INR has fallen by around 8.5 to 9% in the last 1 year. And the long-term trend used to be around 3.5 to 4% depreciation per year. But in just 1 year, we have seen more than double of that decline. Now, there are several reasons behind this, like FII outflows, impact of tariffs on exports, geopolitical tensions, and also the rising crude oil prices. But hopefully, once the war ends, things should come back on track, or should normalize, and at least rupee should stabilize. And here you have to carry the mindset that INR depreciation against the US will eventually move back towards its long-term average. And even if it doesn't settle at 3.5, 4%, say, and let us say it stays around 5%, that is still fine, because the current sharp fall is not sustainable. At the same time, you cannot expect the rupee to keep falling at 9% rate every year, right? Because over time, what happens is things move back to their average range, which we also call mean reversal or mean reversion in statistics and reasoning. So now, after understanding all of this, we can say that definitely Indigo is facing the combined brunt of INR depreciation and the ongoing Iran-Israel war. But at the same time, you also have to keep a long-term outlook. The company was expanding in international markets because international operations provide a natural hedge against the dollar. Since international revenue comes in dollars, it offsets or helps to offset currency risk. And as we discussed earlier, around 20 to 23% of Indigo's revenue comes from international flights. But what has happened is, due to the war and airspace closure, that has backfired as this part is currently being impacted. But you need to think again in this way that in the end, this is a short-term problem. In the near future, once the war ends, the Middle East and overall international business will normalize again. And to handle this short-term uncertainty, the company has strong enough liquidity. You will see here in this screenshot from their investor presentation that Indigo has around 37,000 crore rupees of cash reserves, which provide a solid support to the business. Now, I know some of you might quote platforms like Screener in the comments. There you might see a higher debt to equity ratio over there. But that is completely normal for airline companies because aircrafts are extremely expensive. So companies usually take them on lease instead of buying them outright, which makes the debt levels appear higher. But this is the nature of the business that you have to understand. So overall, Indigo's leverage ratios are well under control. The company is very fundamentally, I'll not say very, but sustainably fundamentally strong right now and well positioned to pass this period of uncertainty. And as for the rupee depreciation, the company had already been taking steps to manage it. They had earlier put in place a $1 billion hedging program, which they are now increasing to around $3 billion. Secondly, once the international business normalizes, it will also help in offsetting forex losses, obviously. And third and last, the company is gradually expanding its own fleet. If you look at this screenshot, a year ago, they had owned fleet of 6 aircrafts, which they have now increased to 28 aircrafts within just 1 year. And owned fleet also provides protection against dollar appreciation. So overall, Indigo is a good business that you can explore on your own. And right now, the valuation is also quite attractive. Indigo is trading around 35 PE, even though this year has not been very strong from an EPS perspective. So once the war ends, operations normalize and crude oil prices will also come back to normal levels, then these triggers should play out and we may also see a PE re-rating happening over here in Indigo. And again, you have to understand that all of these are short-term problems, while from a long-term perspective, Indigo remains a very strong business. The sector landscape is also in their favor because I'll tell you, currently the aviation sector is facing supply side constraints. Demand is strong, but there are not enough aircrafts available for airlines. Airlines do want to expand, but manufacturers don't have enough capacity to produce planes at that pace. Boeing is facing its own issues and Airbus is already overbooked. And mind you, there is a 6 to 7 year waiting period in the industry, which means if you place an order today, you might get the aircraft only after 7 to 8 years. That is a big problem, right? And it is not easy to bring capacity in aviation sector quickly. In such an environment, Indigo has already secured a strong position by controlling around 60% of the order book. Globally, India has placed the highest number of orders for aircrafts, around 1600, out of which Indigo alone has booked around 940 aircrafts or around 60%. That is why I am saying that this current 64% market share monopoly will sustain in the long term as well. Because see, even if players like Akasa or Air India want to expand today, it won't be easy because they simply cannot acquire aircraft quickly enough. On the other hand, Indigo has an aggressive plan. It aims to add one aircraft every week by 2035. So this is a strong, large cap monopoly business that you can study further. The supply side constraints themselves are acting as a moat for the business, but you need to approach it with a long-term perspective. Now, I hope you like this video. If yes, do make sure to hit the like button. This will help me to know whether you are enjoying this stocks for market correction series or not, so I can bring more such videos for you. And yes, if you have any doubts or queries regarding the stock, you can ask them in the comments. I will try to, I'll try my best to answer them. Anyways, I'll see you in the next video. Happy investing.